Before we begin, please remember that I am not a licensed financial advisor. This presentation is for informational and educational purposes only and should not be considered financial, legal, or tax advice. The information provided is based on my own research and experience. Investing involves risk, including the potential loss of principal. Always conduct your own thorough research and consult with a qualified professional before making any investment decisions. Let's be honest. You've felt it, haven't you? That quiet anxiety when you look at your savings account and realize the number is going up, but your actual buying power is going down. You see the price of groceries, gas, and housing creep higher and higher, and you know deep down that the dollars you're working so hard for are slowly being eroded by inflation. You watch the stock market swing wildly, up one day and down the next, driven by headlines and algorithms you can't control. And you wonder, is there anything real? Anything tangible I can put my money into that isn't just a number on a screen, a promise from a government, or a stock certificate for a company that might not exist in 20 years. For 5,000 years, humanity has had an answer to that question. Gold. It's the ultimate store of value. It has outlasted every empire, every government, and every single paper currency ever printed. It's the financial bedrock that people turn to when uncertainty and fear grip the markets. It's not about getting rich quick. It's about not getting poor slowly. So the decision to add gold to your portfolio feels like a smart, stabilizing move. A way to protect your wealth. But that's where the easy part ends and the confusion begins. Because for most of us, buying a bunch of gold bars and burying them in the backyard just isn't practical. So you turn to the modern way, buying gold through your brokerage account. And immediately you're hit with a wall of alphabet soup. ETFs, mutual funds, futures, options, mining stocks. It's overwhelming. The two most common choices, the two heavyweights in the ring, are gold mutual funds and gold exchange-traded funds or ETFs. They sound similar, right? They both let you invest in gold without renting a safe deposit box. But here's the critical truth that most new investors miss. Choosing the wrong one for your situation can be a costly mistake. We're talking about a decision that could impact your returns, your tax bill, and your flexibility for years to come. It's the difference between a sharp, efficient tool and a dull, clunky one that costs you money in hidden fees and lost opportunities. That's why you're here. And my promise to you is this. By the end of this video, you will have absolute clarity. You will understand, in simple terms, the fundamental difference between a gold mutual fund and a gold ETF. You will know the hidden pros and cons of each, the stuff they don't put in the glossy marketing brochures. And most importantly, you will walk away with a simple, powerful framework to decide which one is the right choice for your money, your goals, and your peace of mind. No more confusion, no more guessing. Just confident, informed decisions. So, before we dive into the nuts and bolts of funds versus ETFs, we have to answer a more fundamental question. Why even bother with gold in the first place? In a world of tech stocks, cryptocurrencies, and high-yield savings accounts, isn't gold just a shiny, old-fashioned rock? The answer is a resounding no. Gold plays a very specific and powerful role in a modern investment portfolio, and it boils down to three key functions. First, and perhaps most importantly right now, gold is a hedge against inflation. Think about it like this. The US dollar is what's known as a fiat currency. Its value comes from the fact that the government says it has value, and we all agree to accept it. But the government can also print more of it, trillions more. And when the supply of something increases dramatically, its value tends to go down. That's inflation. It's the silent tax that eats away at your savings. Gold is the opposite. It's a hard asset. You can't just print more gold. The global supply increases by only about 1 to 2% a year, basically whatever can be painstakingly dug out of the ground. This scarcity is what gives it an enduring intrinsic value. So when the value of the dollar is falling, the price of gold, when measured in those weaker dollars, tends to rise. It acts as a financial anchor, holding its value while the currency storm rages around it. The second major role of gold is as a safe haven asset. This is a crucial concept. Most traditional portfolios are built on stocks and bonds. But what happens during a recession, a market crash, or a major geopolitical crisis? Typically, stocks plummet. Corporate bonds can become risky. Fear takes over, and investors sell everything that isn't nailed down. This is where gold shines. Gold often has what's called a negative correlation, or non-correlation to the stock market. In plain English, it means that when stocks are going down, gold is often stable or even going up. Investors flee from risky paper assets and pile into the perceived safety of physical gold. It's portfolio insurance. You don't own car insurance because you expect to crash every day. You own it for the day that you might. Gold serves a similar purpose for your wealth. It's the asset that can protect your portfolio during those chaotic, unpredictable market downturns. And third, gold is a hedge against geopolitical instability. Throughout history, whenever there's a major war, a pandemic, a collapse in international trade, or a crisis of confidence in governments, people instinctively turn to gold. It's a universal currency that holds its value across borders and through crises. It doesn't rely on any single government or financial system to maintain its worth. It's a layer of financial security that sits outside of the traditional system, which is why central banks around the world, from the United States to China, hold thousands of metric tons of it in their vaults. They know it's the ultimate asset to have when things go wrong. So owning gold isn't about being a pessimist or a doomsday prepper. It's about being a realist. It's about diversification. It's about adding a stabilizing element to your portfolio that performs differently from your stocks and bonds, protecting you from inflation, market crashes, and global uncertainty. Now that we've established why gold is such a critical component of a resilient investment strategy, we can get back to the main event. The how. How do you, the modern investor, get exposure to this ancient metal in the most efficient way possible? This brings us to our two main contenders, standing in opposite corners of the ring. In one corner, we have the established veteran, the Gold Mutual Fund. It's been around for decades, it's a familiar structure, and it's offered by all the big-name investment companies. In the other corner, we have the newer, faster, more agile challenger, the Gold ETF. It trades like a stock, offers incredible flexibility, and has exploded in popularity over the last 20 years. On the surface, they seem to be doing the same thing. But underneath the hood, they are fundamentally different machines. They are structured differently, they trade differently, they are taxed differently, and they have different cost structures. And understanding these differences is the key to unlocking the right strategy for you. So let's start by pulling back the curtain on the first contender, the Gold Exchange Traded Fund. We're going to break down exactly what an ETF is, how it actually works, and why the way it's legally structured can be a massive advantage, or a potential pitfall if you don't know what to look for. And what you're about to discover might just change the way you think about investing in gold forever. So let's pull back the curtain on the Gold ETF. To understand it, you have to go back to the early 2000s. Before then, if you wanted to invest in gold as an average person, your options were clunky. You could buy physical coins or bars, which meant dealing with dealers, paying premiums over the spot price, and then figuring out the biggest headache of all, storage and insurance. Do you keep it in a safe at home? What if there's a fire? A theft? Do you pay for a bank safe deposit box? That costs money and isn't even fully insured. Or you could trade gold futures, but that was a complex, high-leverage game reserved for sophisticated traders, not your typical retirement investor. The market was begging for a solution, a way to get exposure to the price of gold without the physical hassle. And in November of 2004, Wall Street delivered its answer. The SPDR Gold Shares, ticker symbol GLD. It wasn't just a new product, it was a revolution. It was the first time you could buy and sell an interest in physical gold as easily as buying a share of Apple or Microsoft. Traded on the New York Stock Exchange, and it changed the game forever. But how? How can a stock, a digital entry in your brokerage account, represent a real physical 1,000-pound pallet of gold bars sitting in a vault in London? The magic is in its legal structure. Most gold ETFs, including the big ones like GLD and iShares IAU, are set up as something called a grantor trust. Now, don't let the legal jargon scare you. It's actually a beautifully simple concept. Think of a trust as a legal box. The company that creates the ETF, known as the sponsor, puts an asset into that box. In this case, the asset is massive quantities of physical gold bullion. They then sell shares of the box itself to the public. So when you buy a share of GLD, you're not buying a stock in a gold mining company. You're not buying a derivative. You are buying a fractional, undivided interest in the actual gold held inside that legal box. You are a part owner of the bullion. The grantor part is a crucial tax detail. It means the trust is a pass-through entity. It doesn't pay taxes itself. Instead, any tax consequences flow directly to you, the shareholder. And this is a big deal we'll circle back to because gold is taxed differently than stocks. It's taxed as a collectible, at a potentially much higher rate. But for now, just remember, you own a piece of the gold in the box. So who guards this box? This is where it gets interesting. There's a whole chain of command. You have the sponsor who created the trust. Then you have the trustee, often a massive bank like BNY Mellon, whose job is to legally administer the trust on behalf of shareholders. And then you have the most important player for our purposes, the custodian. This is usually a giant bullion bank like HSBC or JP Morgan. They are the ones with the high-security Fort Knox-style vaults in places like London, Zurich, or New York. They are the physical guardians of the gold. Their job is to receive the gold, store it, and have it audited. But here's the billion-dollar question. How does the number of shares trading on the stock market stay perfectly in sync with the exact amount of gold sitting in that vault? If millions of people are buying and selling shares every second, how does the ETF's price not fly completely off the rails from the actual real-time price of gold? The answer is the secret sauce of every ETF, and it's a process that involves a small elite group of Wall Street players called authorized participants, or APs. These are the giant investment banks and trading firms, think Goldman Sachs, Morgan Stanley, Jane Street. You and I can't deal directly with the gold trust, but they can. They are the only ones allowed to create or destroy the ETF shares. And here's how they do it. Let's say demand for the gold ETF is surging. Everyone wants in, and they're buying up shares on the stock market. This buying pressure pushes the share price slightly higher than the value of the underlying gold it represents. Maybe a share is supposed to be worth $180 based on the gold in the vault, but it's trading on the market for $180.05. An authorized participant sees this tiny difference and smells a risk-free profit. This is called arbitrage. So, the AP goes into the open market and buys the actual physical gold bars. They then deliver a massive block of this gold, typically corresponding to 50,000 or 100,000 ETF shares, directly to the ETF's custodian vault. In exchange for that physical gold, the trust issues the AP a brand new block of ETF shares, created out of thin air. The AP then immediately turns around and sells these new shares on the stock market at that slightly inflated price of $180.05, pocketing that 5-cent difference on every single share. Now what does this do? This act of selling a huge new supply of shares on the market instantly satisfies the public's buying demand and pushes the ETF's price back down, closing that gap. It brings it right back in line with the value of the gold. The system works just as elegantly in reverse. What if there's a panic and everyone is selling the gold ETF? The selling pressure pushes the share price down to, say, $179.95, even though the gold it represents is still worth $180. The authorized participant sees this and swoops in again. They buy up a huge block of those cheap ETF shares on the stock market. They then hand those shares back to the trust and say, "We're redeeming these." The trust, in turn, instructs the custodian to hand over the corresponding amount of physical gold bars. The AP now has gold worth $180 that they acquired for only $179.95. They sell the gold, pocket the risk-free profit, and the ETF shares they turned in are extinguished, they cease to exist. This act of buying up all those cheap shares on the market creates demand, pushing the price of the ETF back up to its true value. It is a constantly self-correcting, self-policing mechanism. It's this constant arbitrage by Wall Street giants that provides the massive advantage of a gold ETF for a regular investor. It ensures that the price you see on your screen is an incredibly accurate reflection of the real-world price of gold, second by second. You get transparent, real-time pricing and the ability to get in or out instantly during market hours, all without ever having to worry about storing a single ounce of metal. Seems like the perfect system. A seamless, efficient, digital bridge to the physical world of gold. But this is where we have to talk about the potential pitfall, the one that lurks just beneath the surface of that convenience. Notice a key detail in this whole process. You, the investor, never touch the gold. You can't call up the ETF sponsor and say, "I'd like to redeem my 50 shares for my little stack of gold bars, please." That right is reserved exclusively for the authorized participants, and only in enormous block sizes. You own a share in a trust. The trust owns the gold. The gold is held by a custodian. This creates a chain of custody, a chain of promises. And anytime you have a chain, there's a risk that one of the links could break. This is what people are talking about when they use the term paper gold. You don't hold the asset itself. You hold a paper claim on the asset. And that brings up some uncomfortable but critically important questions. What if the gold in the vault isn't really there? What if the audits aren't as thorough as they should be? What happens in a true systemic financial crisis if one of these massive institutions in the chain, the custodian, the trustee, were to fail? Your shares are a claim, but in a crisis, is that claim as good as the cold, hard metal in your own hand? This is the crux of the debate. It's the trade-off between unparalleled convenience and what is known as counterparty risk. And on the other side of this debate stands the gold mutual fund. A completely different beast, with a different structure, different rules, and a different set of risks and rewards. It tries to solve the gold investing problem in an entirely different way, and it's a way that most investors completely misunderstand. So let's tear it apart. The single biggest misunderstanding about gold mutual funds is what you are actually buying. When you hear gold fund, your brain probably pictures a vault, something like Fort Knox, with a fund manager adding your little sliver of a gold bar to a giant glittering pile. That is not what a gold mutual fund is. Not even close. When you buy a share of a gold mutual fund, you are not buying gold. Let me say that again because it is the most important sentence you will hear on this topic. When you buy a share of a gold mutual fund, you are not buying physical gold. What you are buying is a collection of stocks. Specifically, you're buying tiny pieces of companies whose primary business is finding gold in the ground, digging it up and selling it. You're investing in gold miners. Barrick Gold, Newmont Corporation, Agnico Eagle Mines. These are businesses. They have CEOs, boards of directors, employees, heavy machinery, debt, quarterly earnings reports, and all the glorious, messy complexity that comes with running a global industrial operation. You're not buying the metal, you're buying the shovel. You're betting on the people and the companies that produce the gold. And this leads to the next logical question. Why on earth would anyone do that? If you want exposure to gold, why not just buy gold? The answer lies in one powerful, seductive, and incredibly dangerous word: leverage. The entire sales pitch for a gold mutual fund boils down to this concept of leverage. The theory is that the stocks of gold mining companies offer a leveraged play on the price of gold itself. This means that a small increase in the price of gold can lead to a much larger increase in the profits of a mining company, and therefore a much larger increase in its stock price. Let's make this real with a simple example. Imagine a company we'll call Bedrock Mining. Let's say the current price of gold is $2,000 an ounce. And for Bedrock Mining, after all their costs, paying their geologists, running the giant trucks, fuel, labor, administrative overhead, their all-in cost to pull 1 ounce of gold out of the ground is $1,500. Simple math, right? $2,000 sale price, $1,500 cost. Bedrock Mining makes a profit of $500 for every ounce of gold they sell. Now let's say the global price of gold gets a little boost. It goes up by just 10%, from $2,000 to $2,200 an ounce. A 10% move in a commodity is pretty standard. It happens all the time. But look what happens to Bedrock Mining's profits. Their cost to mine is still roughly $1,500. It doesn't change overnight. But now they're selling that same ounce of gold for $2,200. Their profit per ounce just went from $500 to $700. Let's look at those numbers again. The price of gold went up 10%, but the company's profit per ounce went up from $500 to $700. That is a 40% increase. A 10% move in the underlying commodity created a 40% explosion in the company's profitability. That is the magic of operating leverage. And in theory, that massive profit growth should send the company's stock price into the stratosphere. Investors see this, they get excited, and they bid the share price up. So you, as an owner of the mutual fund that holds Bedrock Mining stock, could potentially see a 40, 50, or even 60% gain from a mere 10% rise in gold. That is the dream. That is the entire reason gold mutual funds exist. The fund manager's job is to be an expert stock picker in this very specific, very volatile industry. They're not just buying one company like Bedrock Mining. They're building a diversified portfolio. They might buy a piece of a huge, established giant like Newmont, which has mines all over the world. Then they might add a medium-sized producer in Canada, and maybe a smaller, more speculative exploration company in Australia that's hoping to strike it rich. They read the geological surveys. They analyze the balance sheets. They meet with the management teams. You're paying them for their expertise to pick the winners and avoid the losers in the global gold mining industry. So in one purchase, you get a basket of these leveraged plays on gold, professionally managed and diversified across dozens of companies. Sounds pretty good, right? A professionally managed, diversified portfolio designed to amplify the returns of gold. But remember what I said. The word leverage is both seductive and dangerous. Because this leverage is a brutally sharp, double-edged sword. Everything I just described, that beautiful 40% explosion in profits, works in reverse. And this is the part of the sales pitch that often gets whispered. Let's go back to Bedrock Mining. Gold is at $2,000, their cost is $1,500, and their profit is $500 per ounce. Now let's say the price of gold falls by 10%. It drops from $2,000 down to $1,800. Again, a totally normal fluctuation. What happens to Bedrock's profit? Their cost is still $1,500, but now the sale price is only $1,800. Their profit per ounce has collapsed from $500 down to just $300. Gold fell by 10%. Their profit fell by 40%. That same leverage that creates explosive upside also creates devastating, portfolio-crushing downside. A small dip in the price of gold can absolutely annihilate a mining company's profitability, and investors will flee the stock like it's on fire. The share price can easily get cut in half from a minor temporary pullback in the price of gold. But it gets so much worse. The biggest risk, the one that truly separates a gold mutual fund from a direct investment in gold, is that the price of gold is only one factor in a mining stock's success. There are a dozen other ways for you to lose all your money, even if the price of gold is skyrocketing. This is not an exaggeration. You can be 100% right about the direction of gold and still lose everything. How? Let's count the ways. First, you have management risk. The CEO of one of your fund's companies could make a terrible acquisition, paying billions for a mine that turns out to be a dud. Or maybe there's an accounting scandal. The stock plummets, even as gold hits all-time highs. Second, you have operational risk. Gold mining is a heavy, dangerous industrial business. What if a key mine has a catastrophic wall collapse? Production halts. The company bleeds money. The stock gets destroyed. What if the workers at their biggest mine go on a 6-month strike? No gold is produced. The stock gets destroyed. What if their machinery keeps breaking down or their energy costs suddenly triple? Profits vanish. The stock gets destroyed. Third, and this is a huge one, you have geopolitical risk. Most of the easy-to-get gold in safe, stable countries like the US and Canada has already been found. So, many of these companies operate in politically unstable regions of the world. What happens if a new government comes to power in a South American or African country and decides to nationalize the mines? They just seize the asset. Your company now owns nothing. The stock goes to zero. What if they don't seize it, but they slap a new 90% windfall profits tax on the mine? The economics are ruined overnight. The stock gets destroyed. And the list goes on. There's exploration risk, where a company spends $100 million drilling holes in the ground and finds nothing. There's financial risk, where a company took on too much debt and can't pay its bills when interest rates rise. There's even basic stock market risk, where a general market crash can drag down mining stocks right along with everything else, no matter what the price of gold is doing. So when you buy a gold mutual fund, you are making a multi-layered bet. You're betting that the price of gold will go up. You're betting that the fund manager has picked companies with competent, honest management. You're betting that their mines won't collapse, their workers won't strike, and their equipment won't fail. You're betting that the foreign governments where they operate will remain stable and friendly. And you're betting that they'll be able to manage their finances prudently. It is a bet on a business, not on a metal. It is an active, complex, and incredibly high-risk equity investment that simply uses the price of gold as one of its main, but not only, ingredients. So you have this incredibly complex, volatile investment that can either supercharge your returns or completely incinerate them. But how does it actually work on a practical level? How do you buy it? What are the fees? And what's the single biggest trap that new investors fall into when they pick one? That's where we're going next. Let's start with the ETF, the exchange-traded fund. Buying a gold ETF is almost identical to buying a share of stock in a company like Apple or Tesla. The first thing you need is a brokerage account. Think of this as your personal gateway to the stock market. We're talking about platforms like Fidelity, Charles Schwab, Vanguard, or even newer, app-based brokers like Robinhood or Webull. If you have a 401k or an IRA, chances are you already have an account with one of these big players. Once you're logged in, you don't search for gold. You search for the fund's ticker symbol. A ticker is a unique 1 to 5 letter code that identifies a security on the stock exchange. For the biggest gold ETFs, you're looking at tickers like GLD, for the SPDR Gold Shares, or IAU, for the iShares Gold Trust. You type that ticker into the search bar and it pops up just like a stock. And here's the crucial part. It has a live ticking price. Throughout the trading day, from the opening bell at 9:30 a.m. Eastern Time to the closing bell at 4 p.m., the price of that ETF share is constantly fluctuating. It moves up and down second by second, based on supply and demand, just like any other stock. This is called intraday trading. It means if you see a price you like at 11:02 a.m., you can place an order to buy it right then and there. You can place a market order, which says, buy it for me immediately at the best available price, or a limit order, which says, only buy it for me if the price hits this specific number or lower. You have that level of granular real-time control. You click buy, and within seconds you own shares of the Gold ETF. It's fast, it's liquid, and it feels exactly like participating in the stock market because that's precisely what you're doing. Now let's completely switch gears and look at the Gold Mutual Fund. The experience is fundamentally different. While you can often buy mutual funds through that same brokerage account, the process lacks that real-time heartbeat of the market feel. When you go to buy a share of a Gold Mutual Fund, you won't see a price that's changing every second. Instead, you're placing an order to buy at a price that hasn't been determined yet. This is the single biggest mechanical difference. Mutual funds are only priced once per day, after the market closes. This price is called the net asset value, or NAV. The fund's managers wait until the 4 p.m. closing bell. They add up the total value of all the gold and other assets the fund holds, subtract any liabilities, and then divide that by the number of shares outstanding. That final number is the NAV, and it's the price everyone who bought or sold that day gets, regardless of whether they placed their order at 10 a.m. or 3:59 p.m. Think of it like this. Buying an ETF is like going to a live auction where you can bid and win an item instantly. Buying a mutual fund is like placing a silent bid in a box, and at the end of the day, the auctioneer opens all the boxes and executes all the transactions at a single calculated price. You don't get the intraday price movement. You're buying based on yesterday's closing price and hoping for the best when today's price is calculated. Some investors like this simplicity. It removes the temptation to time the market throughout the day. Others hate it, feeling a complete lack of control over their entry price. Okay, so you've navigated the brokerage account, you understand the difference between intraday ETF pricing and end-of-day mutual fund NAV. You've clicked the buy button. You're an owner, but ownership comes at a cost. And this is where we uncover the single biggest trap, the silent killer of returns that trips up millions of investors. I'm talking about fees, specifically the expense ratio. Every single ETF and mutual fund, gold or otherwise, has an expense ratio. It's the annual cost of running the fund, expressed as a percentage of your investment. This fee covers everything: the fund manager's salary, administrative costs, marketing, legal fees, and in the case of gold funds, the very real and very expensive cost of storing and securing massive quantities of physical gold bullion in high-security vaults. This fee isn't sent to you as a bill. You'll never write a check for it. Instead, it's skimmed directly and discreetly from the fund's assets every single day, which ever so slightly reduces the fund's daily return. It's a ghost in the machine, a silent partner you never meet who is guaranteed to get paid before you do. And here's the trap. When you're comparing two gold funds, you might see one with an expense ratio of, say, 0.25% and another with an expense ratio of 0.75%. The new investor's brain looks at that and thinks, what's the big deal? It's 0.5%. That's nothing. That single thought, that dismissal of a small percentage, can be one of the most expensive financial mistakes you ever make. It's the difference between a small leak and a gaping hole in the hull of your financial ship over the long term. Let's do the math. Let's say you invest $10,000 into gold. For simplicity, let's assume the price of gold itself doesn't change for 20 years, so we can isolate the impact of the fees. You put your $10,000 into Fund A, the Gold ETF, with a lean 0.25% expense ratio. In the first year, the fee costs you $25. Not so bad. You put another $10,000 into Fund B, the Gold Mutual Fund, with a higher 0.75% expense ratio. In the first year, that fee costs you $75. Still, maybe not enough to lose sleep over. But this fee is not a one-time event. It's a relentless compounding drag on your investment, year after year after year. Let's fast forward 20 years. Your $10,000 in Fund A, with a 0.25% fee, has been eroded by about $488. Your remaining balance is $9,512. But your $10,000 in Fund B, with the 0.75% fee? Over those same 20 years, the fees have devoured almost $1,400 of your principal. Your remaining balance is just $8,607. That tiny 0.5% difference didn't cost you $50 a year. Over 2 decades, it cost you nearly $1,000 extra. It vaporized a full 10% of your initial investment. Now imagine if the investment was $100,000. That difference balloons to a nearly $10,000 loss, all for owning a product that was designed to do the exact same thing. Track the price of gold. And this example didn't even include investment growth. When your investment grows, that percentage-based fee grows right along with it, taking an even bigger bite out of your returns. It's a wealth-destroying machine hiding in plain sight. This is the trap. It's ignoring the expense ratio. It's the single most important number to look at after you've confirmed a fund does what you want it to do. Historically, gold ETFs have been able to offer much lower expense ratios than their mutual fund counterparts, partly due to their structure and scale. It's not uncommon to see gold ETFs in the 0.15% to 0.40% range, while many gold mutual funds can easily run from 0.5% all the way up to over 1%, especially if they include other fees like loads. A load is just a fancy word for a sales commission. A front-end load is a commission you pay up front when you buy the fund, which might be 3 to 5% of your investment. A back-end load is a fee you pay if you sell within a certain number of years. Thankfully, no-load funds are now the standard, but you absolutely have to check the fine print. So the mechanics are clear. ETFs trade like stocks, live and fast. Mutual funds price once a day, slow and steady. But beneath the surface, the true battle for your returns is fought on the field of fees. That tiny percentage point, the expense ratio, is the unseen enemy that can determine whether your golden nest egg hatches or cracks. We now understand how to buy them and what the hidden costs are. But this all leads to a much deeper, more fundamental question. When you buy a share of GLD or a gold mutual fund, what do you actually own? Is there a little gold bar in a vault in London or Zurich with a microscopic engraving of your name on it? Or are you just owning a piece of paper, a promise, a derivative that's several steps removed from the real thing? The answer to that question reveals the core philosophical debate at the heart of gold investing, and it's far more controversial than you might imagine. We're about to pull back the curtain on the vaults, the audits, and the paper trail that separates you from your gold. So let's start with the gold ETF, the modern digital gateway to the ancient metal. When you buy a share of a major gold ETF like GLD or IAU, you are buying into a simple, powerful promise. For every share that exists, there is a corresponding specific amount of physical gold, held securely in a vault on your behalf. It's an elegant idea. You click a button in your brokerage account, and somewhere in a high-security vault in London, New York, or Zurich, a sliver of a 400-ounce gold bar is now allocated to the trust that you partly own. Feels direct. Feels real. The fund's prospectus will tell you exactly this. It will name the custodian, typically a massive banking institution like HSBC or JP Morgan, the very entity responsible for safeguarding the bullion. They will tell you that the gold is allocated, which is a critically important term. Allocated gold means specific, identifiable bars, each with a unique serial number, are set aside in the vault under the fund's name. This is the opposite of unallocated gold, which is more like an IOU from the bank, a general claim on a pool of gold that the bank also uses for its own purposes. So, allocated gold, that sounds safe, right? Your gold is not just a number in a bank's ledger. It's a physical object with a serial number. To prove it, these funds conduct regular audits. Once or twice a year, an independent auditor goes into the vaults and counts the bars. They check the serial numbers against the fund's official bar list, which is often published daily on their website. You can literally go online right now, look up the list for an ETF like GLD, and you will find a spreadsheet with thousands upon thousands of entries, each one detailing a specific gold bar, its serial number, its refiner, its exact weight, and its purity. It's an astonishing display of transparency. It's designed to give you absolute confidence that the gold is there, that your digital share has a physical anchor in the real world. But here is where the curtain begins to tear. The first layer of separation is the structure itself. You don't own the gold. The trust owns the gold. You own a share of the trust. It's a subtle but legally profound distinction. You have no direct claim on the physical metal. You can't call up the custodian and say, "I own 100 shares. Please mail me my 10 ounces of gold." That's not how it works. The only entities that can exchange ETF shares for physical gold are what's known as authorized participants. These are the giant financial institutions, the market makers, the Goldman Sachs and Morgan Stanleys of the world. They are the only ones with the right to go to the trust and say, "Here are 50,000 shares, give us the corresponding pile of gold bars," or vice versa. They do this in huge blocks to keep the ETF share price trading in line with the actual spot price of gold. But for you, the retail investor, Your only option is to sell your share to someone else on the stock market for cash. You can never, ever touch the underlying asset. You have a key to a vault, but the door will only open for a select few, and you are not on the list. Now let's talk about those audits. While they provide a snapshot in time, confirming the gold was there on the day of the count, skeptics raise pointed questions. What happens between the audits? How rigorously is the chain of custody tracked? And the most explosive question of all, could that gold be pledged to more than one owner? This concept, known as rehypothecation, is the ultimate boogeyman of the gold world. While ETF prospectuses strictly forbid this, the complexity of the global custodian system, with its sub-custodians and intricate chains of ownership, creates a fog that makes 100% certainty a very elusive thing. You are putting your faith not just in the ETF provider, but in a whole chain of financial institutions, and in an auditing process that provides a glimpse, not a continuous video feed, of what's in the vault. The promise is physical gold, but the reality is a complex paper trail that you have to trust implicitly. So, if the ETF is a claim on a vault you can never enter, what about the gold mutual fund? This must be the simpler, more traditional alternative, right? This is perhaps the single biggest and most dangerous misunderstanding in the world of gold investing. When you buy a share in the average gold mutual fund, you are not buying gold. Let me repeat that. You are not buying gold. You are not buying a claim on gold in a vault. You are not buying a piece of a 400-ounce bar. You are buying stocks. Specifically, you are buying a collection of stocks in companies that mine gold. Think about what that actually means. You are not investing in the stable, inert, yellow metal. You are investing in a business. A highly complex, incredibly risky, and notoriously volatile business. Your investment is now subject to 1,000 variables that have absolutely nothing to do with the price of gold. Is the company's management team competent or corrupt? Did their geologists make a good survey? Or is the mine going to be a bust? What is the political stability of the country where the mine is located? A sudden change in government or a new mining tax could vaporize your investment overnight. Even if the price of gold is soaring, you're exposed to operational risks. Can they extract the gold from the ground efficiently? What if a critical piece of machinery breaks down? What about labor strikes? You're exposed to financial risks. How much debt is the company carrying? Did they make bad bets on hedging their future production? Locking in a low price just before gold skyrocketed? The performance of a gold mining stock can, and often does, completely decouple from the performance of gold itself. In a bull market for gold, mining stocks can act like a leveraged bet, soaring much higher and faster than the metal. But in a bear market, or when a company hits a snag, the stock can plummet to zero, while the physical gold it was supposed to be digging up is still sitting comfortably at over $2,000 an ounce. A gold ETF is designed to be a direct proxy for the price of gold. Its goal is to mirror the spot price, minus a small expense fee. A gold mutual fund is an actively managed portfolio of equities in one of the riskiest sectors on the planet. One is a commodity tracker. The other is a stock portfolio. They are fundamentally different investments, designed for different purposes, with wildly different risk profiles. Yet both are sold under the simple, alluring banner of gold. One offers you a paper claim on a real asset, wrapped in layers of financial complexity and trust. The other offers you a direct stake in the brutal, messy, and unpredictable business of ripping that asset out of the earth. So we have two fundamentally different beasts masquerading under the same gold label. One is a digital key to a vault you can never enter. The other is a ticket to the world's most dangerous and unpredictable business. The question is no longer which is better, but which risk are you actually willing to take? And the answer will force you to confront the real reason you wanted to own gold in the first place. So let's break down those reasons. At the highest level, there are two kinds of gold investors, two competing philosophies that are almost mutually exclusive. And the product you choose, the ETF or the mutual fund, is a direct reflection of which camp you belong to, whether you realize it or not. In the first camp, you have the preservationist. This is the investor who sees gold not as a way to get rich, but as a way to not become poor. They are deeply skeptical of the financial system. They see governments printing money with reckless abandon. They see national debt spiraling into the stratosphere. And they see a house of cards that could come tumbling down. For them, gold is not an investment. It's insurance. It's the ultimate break glass in case of emergency asset. Their nightmare isn't a 20% stock market correction. Their nightmare is a currency collapse, a banking crisis, A world where the paper promises that underpin our entire economy suddenly become worthless. They don't just want exposure to the price of gold. They want a claim on the physical thing itself, the heavy yellow metal that has been money for 5,000 years and will be money for 5,000 more, long after the dollar, the euro, and the yen are footnotes in a history book. In the second camp, you have the strategist. This investor isn't necessarily planning for the apocalypse. They are a student of modern finance. They work within the system, and they want to optimize their returns within it. They've read the books on portfolio theory. They understand that stocks and bonds are the engines of wealth creation. But they also know that those engines can stall. They see gold as a diversifier, a non-correlated asset. Its purpose is elegantly simple. When their stocks are plummeting, gold tends to hold its value or even rise, acting as a shock absorber for their entire portfolio. The strategist cares about three things above all else: liquidity, cost, and efficiency. They want to be able to buy and sell their gold position with a single click, for the lowest possible fee, without ever having to think about where or how it's stored. For them, gold is just another line item in their brokerage account, a tool to be used to achieve a specific financial goal. The preservationist and the strategist. Insurance versus a tool. The end of the world versus the end of the quarter. These two mindsets lead to radically different conclusions about what makes a good gold investment. And this is where the ETF and the mutual fund enter the picture, because they serve these two masters in completely different ways. Let's start with the strategist, the portfolio optimizer. For them, the gold ETF is a modern miracle. Think about what it took to invest in gold before they existed. You had to find a reputable dealer, pay a significant markup over the spot price, figure out how to transport it securely, then pay for insured storage in a vault, and when you wanted to sell, you had to do the whole process in reverse, again paying a commission. It was slow, expensive, and clumsy. Then, in 2004, the SPDR Gold Shares ETF, ticker symbol GLD, came along and changed everything. The concept was revolutionary in its simplicity. A trust is created, and this trust does one thing and one thing only. It buys and holds enormous quantities of physical gold bars in a secure vault, mostly in London. Then, it issues shares that trade on the stock exchange just like shares of Apple or Microsoft. Each share represents a fractional ownership of the gold in that vault. Suddenly, with a single click, a strategist could buy or sell exposure to the price of gold, instantly at any time during the market day. The fees, known as the expense ratio, were a tiny fraction of the costs of owning physical metal. The bid-ask spread, the tiny difference between the buy and sell price, is razor thin, meaning you're not losing money just by getting in and out. For the strategist, whose only goal is to have an asset in their portfolio that tracks the price of gold with maximum efficiency and minimum cost, the gold ETF is a near-perfect solution. Solves all their problems. But for the preservationist, the investor who buys gold as a hedge against system collapse, the gold ETF is not a solution at all. In fact, to them, it's part of the problem. It's just another paper promise, another layer of abstraction within the very financial system they're trying to insure themselves against. And their fears are not entirely unfounded. When you dig into the fine print of these ETF prospectuses, the long, boring legal documents that almost nobody reads, you start to see the cracks. You see, when you buy a share of a gold ETF, you don't actually own gold. You own a share in a trust that owns the gold. That's a critical legal distinction. You have what's known as counterparty risk. You are dependent on the trust, the custodian bank that holds the gold like HSBC or JP Morgan, and the entire chain of financial plumbing to make good on their promise. The preservationist asks a simple question. In a true systemic crisis, the very crisis they are preparing for, will that chain hold? What if the custodian bank fails? What if the government decides to reclassify or seize these massive centralized gold hoards? Furthermore, for most retail investors, you cannot redeem your ETF shares for physical gold. If you own $1 million of GLD and you call them up and say, "I'd like my gold bars, please," they will politely tell you to sell your shares on the open market for cash, just like any other stock. The ability to redeem for physical metal is typically reserved only for massive, authorized participants like the big investment banks. So, in the exact scenario where the preservationist would want the gold, a situation where cash is losing its value and physical assets are king, the ETF only gives them the one thing they don't want: more cash. For them, this is the ETF's fatal flaw. It's a brilliant tool for tracking the price of gold, but it fails the ultimate end-of-the-world stress test. This is where you might think the gold mutual fund steps in as the answer for the preservationist. But this is the single biggest, most dangerous misconception in the entire world of gold investing. The vast majority of investments labeled gold mutual funds are not, in fact, an alternative to gold ETFs. They are a completely different animal, with a completely different set of risks. A gold ETF like GLD or its lower-cost competitor IAU is designed to be a direct proxy for the metal itself. It holds physical bullion. Its value is tied directly and exclusively to the spot price of gold. A typical gold mutual fund, on the other hand, does not hold gold bars. It holds stocks. Specifically, it holds a portfolio of shares in companies that mine gold. Let that sink in. Owning a gold ETF is like owning a digital receipt for a bar of gold sitting quietly in a vault. Owning a gold mutual fund is like becoming a part owner in a portfolio of complex, global industrial businesses that are engaged in the brutal, expensive, and geopolitically fraught process of ripping that gold out of the ground. You are no longer making a pure bet on the price of gold. You are now making a bet on dozens of other factors. You're betting on the competence of the mining company's CEO and management team. You're betting on their geologist's ability to accurately estimate how much gold is in a deposit. You're betting on their engineer's ability to extract it profitably. You're betting against mine collapses, equipment failures, and labor strikes. You're betting on the political stability of the countries where the mines are located. From Peru to South Africa to Russia, a new government could come to power and decide to nationalize the mine or impose a windfall profits tax, wiping out shareholders overnight. This exposes you to a whole new world of risk that has nothing to do with the price of gold. Imagine a scenario where the price of gold doubles. The owner of a gold ETF is ecstatic. Their investment has essentially doubled, minus a tiny fee. But the owner of the gold mutual fund might be in for a nasty surprise. What if the fund's largest holding, a major mining company, just had a catastrophic environmental disaster at its main facility, leading to billions in cleanup costs and a complete shutdown of operations? Or what if they hedged their gold production at the old, lower price and are now legally obligated to sell all their gold for half of what it's worth on the open market? In these scenarios, even as the price of gold is soaring to the moon, the stock of that mining company, and therefore the value of your mutual fund, could be plummeting to zero. However, this leverage cuts both ways. This is the siren song that lures investors to mining stocks. Let's say a mining company's all-in cost to produce 1 ounce of gold is $1,800. If the price of gold is $2,000, their profit margin is $200 per ounce. Now, let's say the price of gold increases by just 25% to $2,500. Their cost is still $1,800, but their profit margin is now $700. A 25% increase in the price of the commodity led to a 250% increase in the company's profit. This operational leverage can create absolutely explosive returns for mining stocks, returns that a simple bullion ETF could never hope to match. So the choice isn't just ETF versus mutual fund. It's a choice between the cold, sterile certainty of a vault and the chaotic, mud-caked gamble of the mine. One is a bet on gold. The other is a bet on the people who rip it from the earth. And before you can decide which bet to place, you have to understand the single most overlooked factor that determines whether a gold miner strikes it rich or strikes out completely. It's a single number, a line item on a balance sheet that most amateur investors skip right over. But to the pros, it's everything. It's called the all-in sustaining cost, or AISC, and it is the secret key to understanding the entire gold mining industry. See, we tend to think of mining as a simple equation: find gold, dig it up, sell it, profit. But the reality is brutally complex. Getting an ounce of gold out of the ground isn't like picking an apple from a tree. It's like trying to extract a single grain of sugar from a mountain of sand in the middle of a hurricane, using tools that cost $1 billion. The all-in sustaining cost is an attempt to capture every single penny of that struggle. Think of it this way. Imagine you open a high-end bakery. Your cash cost is the flour, the sugar, the eggs for each cake you sell. That's easy to calculate. But that doesn't tell the whole story, does it? What about the rent for your storefront? The electricity for the ovens? The salary for your baker? The marketing flyers you printed? The new industrial mixer you have to buy every 5 years to replace the old one? When you add all of that up, the direct costs, the overhead, the maintenance, the administrative salaries, you get your all-in sustaining cost to produce one cake. It's the true cost to stay in business. Gold mining is the same, just on an epic scale. The cash cost is the diesel for the giant haul trucks, the explosives, the chemicals used to leach the gold from the ore, and the wages for the miners working deep underground. But the AISC includes so much more. It includes the cost of building roads to the remote mine site, the cost of the corporate office in Denver or Toronto, the millions spent on geological surveys just to find the next patch of profitable rock to keep the mine from running dry. It includes the environmental cleanup costs, the community development funds, the security teams, the accountants, the lawyers. Everything. It is the true unvarnished price tag for producing 1 single ounce of gold. And this number, this AISC, is what creates the violent, explosive price swings that make gold mining stocks famous. It all comes down to a powerful financial force called leverage. And here's how it works. Let's say the price of gold is sitting at $2,000 an ounce. We have two different mining companies. Miner A is a world-class operator. They have a rich deposit, a brilliant engineering team, and their all-in sustaining cost is just $1,200 an ounce. For every ounce they sell, they pocket a fat $800 profit. They are a cash printing machine. Then you have Miner B. They're not as fortunate. Their mine is in a tougher location, the ore isn't as high grade, and their AISC is $1,800 an ounce. They're still profitable, but just barely. For every $2,000 ounce they sell, they only make $200 in profit. Now watch what happens when the price of gold moves. Let's say some positive economic news comes out, and the price of gold jumps by 10%, from $2,000 to $2,200 an ounce. A 10% move. For the physical gold ETF investor, their investment is up 10%. Simple. But look at our miners. For Miner A, their profit per ounce just went from $800 to $1,000. A 10% rise in the price of gold created a 25% surge in their profits. That's fantastic leverage. But now look at Miner B. Their profit per ounce just went from $200 to $400. A 10% rise in the price of gold doubled their profits. A 100% gain. Their stock price doesn't just go up, it goes ballistic. It explodes. This is the magical allure of mining stocks. The potential for a small ripple in the gold market to create a tidal wave of profits for the miners. But leverage is a weapon that cuts both ways. And the other edge is razor sharp. Let's rewind. Gold is back at $2,000. But this time the Federal Reserve hints at raising interest rates, and the gold price falls by 10%, down to $1,800 an ounce. The physical gold ETF investor is down 10. A manageable loss. What about the miners? Miner A, our efficient operator, sees their profit fall from $800 an ounce to $600. That's a 25% hit to their bottom line. It hurts, but they're still solidly profitable. They'll weather the storm. But Miner B, their all-in sustaining cost was $1,800. The price of gold just fell to $1,800. Their $200 profit margin has vanished. It's gone. They are now spending $1 to make $1. They are a zero-profit enterprise. Their stock price doesn't just fall, it gets vaporized. Investors flee for the exits, knowing that if gold drops another $50, the company will be losing money on every single ounce it pulls from the earth, burning through cash just to keep the lights on. This is the brutal reality of the gold mining business. It is a game of margins played for the highest stakes. A company's entire fate can hinge on a few percentage points of movement in the commodity price, filtered through the lens of their all-in sustaining cost. This isn't just a theoretical exercise. This happens in the real world constantly. Imagine a company, let's call them Bedrock Gold, spends $2 billion building a massive new mine in Nevada. Their feasibility studies, based on years of drilling and analysis, project an AISC of $1,300 an ounce. At the time, gold is trading at $1,900. Wall Street is ecstatic. A $600 margin per ounce. The stock soars as they pour the first gold bar. But then reality hits. The price of diesel fuel, which powers their entire fleet of trucks and generators, spikes because of a war overseas. Their unionized workforce negotiates a hefty new contract, raising labor costs. An unexpected geological fault line forces them to spend an extra $100 million on rock stabilization. Suddenly, their AISC isn't $1,300 anymore. It's crept up to $1,600. Their margin has been cut in half, through no fault of their own. Then, a global recession scare pushes the price of gold down to $1,700. In the span of a year, their once massive $600 profit margin has shriveled to a measly $100. The stock, once a Wall Street darling, collapses by 90%. This is the risk you take on. When you buy a gold miners mutual fund or an ETF like the VanEck Gold Miners ETF, the famous GDX, you aren't buying one company like Bedrock Gold. You're buying a basket of dozens of them. This diversification protects you from a single mine caving in or a single CEO making a terrible decision. But it does not and cannot protect you from the fundamental nature of the business. You are still making a leveraged bet on the price of gold, mediated by the operational efficiency, the all-in sustaining cost of the entire sector. When gold is rising, these funds can feel like a rocket ship, dramatically outperforming the metal itself. But when gold falls, the leverage works in reverse, and the floor can drop out with terrifying speed. So, when you're looking at a fund, you're trusting the fund manager, or the index it tracks, to pick the winners, the miners with low costs, long life assets, and smart management. But even if you pick a company that has all of that, the lowest costs in the industry, a mountain of proven gold reserves, and a management team of certified geniuses, you still haven't eliminated the biggest risks. Because the most dangerous threats to a gold mine aren't buried a mile underground with the ore. They're found in a politician's decree, at the front of a protest line, or staring down the barrel of a gun. And that's where this high-stakes game of risk and reward gets truly unpredictable. Let's take a real-world example. Imagine a massive state-of-the-art gold mine in a developing nation. A company, let's call it global, or has poured billions into it. They've built roads, schools, hired thousands of local workers. Everything is running smoothly. The stock price is soaring. Your mutual fund, which holds a big chunk of this company, is making you a very happy investor. Then, overnight, a new government is elected on a wave of nationalist sentiment. Their first act? A decree that all foreign-owned natural resources are now the property of the state. Nationalization. Just like that, with the stroke of a pen, Global Ore's most valuable asset is gone. The company's stock plummets 80% in a single day. Your mutual fund takes a catastrophic hit. You didn't do anything wrong. The geologists didn't get it wrong. The engineers didn't fail. The price of gold didn't even change. The entire value of your investment was wiped out by a political decision made thousands of miles away. This isn't a hypothetical. It has happened in various forms time and time again throughout history. Venezuela, Zimbabwe, the Democratic Republic of Congo. The list of countries where political risk has vaporized shareholder value is long and sobering. Now let's contrast that with the physical gold ETF. While that political drama unfolds, what happens to the gold sitting in the ETF's vault? Absolutely nothing. The gold bars, stamped with serial numbers and stacked in a high-security fortress in London, or Zurich or New York, are completely insulated from that specific geopolitical nightmare. They don't care who the new president of some far-flung country is. Their value is tied to the global market price of gold, not the political stability of a single mining jurisdiction. This is a fundamental, game-changing difference. One is a claim on a business operation, with all its human and political frailties. The other is a claim on a tangible, inert, and politically neutral element. To truly grasp this, you have to understand what that ETF vault really is. It's not just a big warehouse. We're talking about facilities operated by giants like JP Morgan, HSBC, and Brink's, institutions whose entire reputation is built on security. These vaults are among the most secure locations on planet Earth. Think multi-ton steel doors that can withstand a direct blast. Think seismic sensors, motion detectors, and 24/7 armed guards. Access is controlled by dual key systems, biometric scanners, and codes that change constantly. It's the stuff of Hollywood heist movies, but it's real, and it's all designed to protect one thing: the assets of the investors. Inside, every single gold bar is meticulously accounted for. These aren't just generic lumps of metal. They are London Good Delivery bars, meaning they meet the stringent standards of the London Bullion Market Association for purity, weight, and dimension. Each bar has a unique serial number, a stamp from an approved refiner, and a year of manufacture. And this is the crucial part. They are audited constantly. Independent auditors come in twice a year for most major ETFs to physically count and inspect the bars. They check the serial numbers against the ETF's official bar list, which some funds even publish online. This creates an unbroken chain of custody and a level of transparency that is simply impossible in the world of mining. You can't exactly go and audit the gold reserves a mile underground in a mine in Peru, but you can, with absolute certainty, verify the exact number of gold bars held in trust for ETF shareholders. This brings us to the mechanical heart of the ETF, the creation and redemption process. It's the magic that ensures one share of the ETF is always worth very nearly 1/10 of an ounce of gold, or whatever the ratio is. It works like this. When there's more demand for the ETF than there are shares available, Specialized financial institutions called authorized participants, or APs, step in. They don't just ask the ETF to print more shares. No, the AP has to go into the real world, onto the physical bullion market, and buy 100,000 ounces of actual gold. They then physically deliver that gold to the ETF's vault. Only after the custodian verifies the delivery does the ETF issue a corresponding block of new shares to the AP, who can then sell them on the stock market to investors like you. The process works in reverse too. If lots of people are selling, the AP will buy up a huge block of shares from the market, take them to the ETF, and redeem them for the equivalent amount of physical gold straight from the vault. This constant arbitrage, this physical exchange of metal for shares, is what keeps the ETF's market price permanently tethered to the spot price of gold. It's a direct physical link. Your share isn't just a number on a screen. It represents a fractional, undivided interest in a specific pile of audited, insured, and heavily guarded gold. Think back to our mutual fund investor. Their list of worries is a mile long. Will the new mining project hit a geological fault? Will the cost of diesel fuel skyrocket and crush profit margins? Did the CEO just make a terrible acquisition? Will a new environmental regulation shut down the whole operation? Will a labor strike halt production for 6 months? All of these are company-specific, operational risks that have absolutely nothing to do with the price of gold itself. The ETF investor has only one primary concern. What is the price of gold today? All that other noise, all those other layers of risk are stripped away. But the differences don't stop there. Let's talk about something incredibly important in volatile markets. Liquidity. That's a fancy word for how quickly and easily you can turn your investment back into cash at a fair price. Gold ETFs trade on the stock exchange just like a share of Apple or Microsoft. The market is open from 9:30 a.m. to 4 p.m. Eastern Time. If a major global event happens at 11 a.m. and you see the price of gold spiking, you can log into your brokerage account and sell your ETF shares in seconds. The price you see is the price you get. It's instantaneous. Now consider the mutual fund. Mutual funds are only priced once per day, after the market closes, at a value called the net asset value, or NAV. If that same event happens at 11 a.m. and you put in an order to sell your gold mining mutual fund, you are flying blind. You have no idea what price you will get. You have to wait until after 4 p.m. when the fund calculates its final value for the day based on the closing prices of all the stocks it holds. In those 5 hours, the market could have swung wildly. The price you ultimately receive could be dramatically different, and potentially much worse, than the price that prompted you to sell in the first place. In a fast-moving crisis, that time lag isn't just an inconvenience. It can be the difference between a profit and a devastating loss. And finally, we have to talk about the slow, silent killer of investment returns: fees. This is where the difference becomes stark. The entire structure of an ETF is designed for efficiency and low cost. They are typically passive investments. They don't have a team of highly paid analysts flying around the world visiting mines. They don't have a star fund manager demanding a multi-million-dollar salary. Their job is simple: buy gold, put it in a vault, and that's it. Because of this, the expense ratios on major gold ETFs are incredibly low, often in the range of 0.25% to 0.40% per year. That means for every $10,000 you invest, you're paying maybe $25 to $40 a year for the management, security, and insurance of your gold. Actively managed mutual funds are a different beast. They employ those teams of analysts and managers. They are doing complex research, financial modeling, and making active bets on which mining companies will outperform. That all costs money. A lot of money. It's not uncommon to see expense ratios on gold sector mutual funds ranging from 0.8% to well over 1.5%. So that same $10,000 might be costing you $80, $120, even $150 or more every single year. It might not sound like a huge difference, but the corrosive power of fees over time is one of finance's iron laws. Over 20 or 30 years, that seemingly small 1% difference in fees can compound and devour tens of thousands of dollars of your potential returns. So the case seems closed, right? The ETF is the clear, logical, superior choice. It's a direct play on gold. It strips out the operational and political risks of mining. It's more transparent, it's instantly tradable, and it's dramatically cheaper. You buy it, you basically own the gold, end of story. But what if I told you that by choosing this safe option, you might be leaving an astronomical amount of money on the table? What if the very thing that makes the mining mutual fund so risky is also its secret superpower? And what if that physical gold in the ETF vault isn't quite as yours as you think. Let's start with the miners. That astronomical money on the table? It boils down to one of the most powerful and dangerous forces in finance: leverage. But this isn't the kind of leverage where you borrow money. This is operational leverage, and it's baked right into the business model of pulling gold out of the ground. Imagine you run a very simple gold mine. To dig up 1 ounce of gold, your total cost for labor, machinery, fuel, everything is $1,500. This is your all-in sustaining cost, or AISC. Now let's say the spot price of gold is $2,000 an ounce. Simple math. You sell your ounce for $2,000, it cost you $1,500 to get it, so you make a profit of $500. Great. But now a wave of economic uncertainty hits. Investors flock to gold, and the price rises by just 10%, from $2,000 to $2,200 an ounce. What happens to your profit? Your cost is still $1,500. But now you're selling that same ounce for $2,200. Your new profit is $700. Think about what just happened. The price of gold went up by 10%. But your profit went from $500 to $700. That's a 40% increase in profit. A 10% move in the underlying commodity created a 40% explosion in your company's profitability. That is the secret superpower. That is operational leverage. This is why, during a roaring gold bull market, gold mining stocks don't just rise with gold. They can multiply its returns. They can absolutely skyrocket, leaving the performance of physical gold in the dust. An investor who buys a gold ETF gets the 10% gain. An investor who chose the right mining fund gets a piece of that 40% profit explosion, which can translate into a stock price that goes up 30, 40, or even 50% or more. The fund is not a direct investment in gold. It's an investment in the business of profiting from gold. And thanks to leverage, that business can be exponentially more profitable when prices are rising. But every superpower has a weakness. Every yin has its yang. This exact same force, this incredible operational leverage, works in reverse. And it is absolutely brutal. Let's go back to our mine. Gold is at $2,000, your cost is $1,500, and your profit is $500. Now the economy looks a little better, investors feel less fearful, and the price of gold falls by 10%, down to $1,800 an ounce. Your costs don't change. They're still locked in at $1,500. But now you can only sell that ounce for $1,800. Your profit has collapsed from $500 down to just $300. The price of gold fell by 10%. Your profit fell by 40%. Suddenly, that fund full of mining stocks is getting crushed. A small, healthy dip in the price of gold can create a catastrophic collapse in the stock prices of the companies mining it. And if the price of gold falls below their cost of production, if gold drops to, say, $1,400 an ounce, their profit isn't just zero. They are now losing $100 for every single ounce they pull from the earth. Their stock price can go to zero even while the gold they're mining is still incredibly valuable. This is the high-stakes bargain of a gold mining mutual fund. You are sacrificing the steady, predictable price tracking of an ETF for a shot at leveraged, supercharged returns. You are accepting the risk of amplified, catastrophic losses for the potential of amplified, life-changing gains. It is a bet not on gold itself, but on the future profitability of the gold industry. Now that brings us to the other side of the coin, the ETF, the safe, stable, physical gold option. But what about that question, is that gold in the vault really yours? When you buy a share of a major gold ETF like GLD or IAU, you are not buying a gold bar. You are not getting a deed of ownership to a specific, serialized brick of metal in a London vault with your name on it. What you are buying is a share in a trust. That trust, in turn, supposedly owns the gold. The gold is held by a custodian, usually a massive investment bank like JP Morgan or HSBC. You don't own the gold. The trust owns the gold. You own a piece of paper, a digital entry in a brokerage account that says you own a piece of the trust. This introduces a concept that every serious gold investor obsesses over: counterparty risk. A counterparty is the other party in a financial transaction. When you hold a physical gold coin in your hand, there is no counterparty. It's just you and the asset. But with an ETF, there are multiple counterparties between you and the metal. There's your broker. There's the ETF trust itself. And there's the custodian bank holding the gold. If any one of those links in the chain fails, you have a problem. The biggest point of concern for many is the custodian. What happens if the massive bank holding all that gold faces a catastrophic financial crisis like in 2008? Now, the ETF prospectuses are filled with legal language designed to protect the assets. They say the gold is allocated and held in segregated accounts, separate from the bank's own assets. In theory, this means if the bank goes under, creditors can't come after the ETF's gold. But in a true system collapsing crisis, the very kind of event that makes people buy gold in the first place, theories and legal promises get tested. You would become one of thousands of claimants in a complex bankruptcy proceeding for a global financial institution. The process could take years, and the outcome is never guaranteed. Furthermore, there's the issue of redemption. Can you, a regular investor with 50 shares of a gold ETF, call them up and say, "I'd like to take delivery of my gold, please?" The answer is a resounding no. Redemption for physical metal is almost exclusively reserved for authorized participants. These are the giant market makers and institutional players who deal in massive blocks of shares, often 50,000 or 100,000 at a time. For everyone else, your only option is to sell your shares for cash. This is the fundamental trade-off of a gold ETF. You are exchanging the absolute certainty of physical ownership for convenience and liquidity. You can buy and sell your claim on gold, your gold proxy, instantly with the click of a button. But you are trusting a chain of financial institutions to make good on that claim. For 99.9% of the time, in normal market conditions, this system works flawlessly. But gold is often bought as insurance for that 0.1% of the time, for the black swan event when the system itself is what breaks. So we stand at a crossroads. In one corner we have the gold mining mutual fund, a volatile, complex instrument that doesn't track gold perfectly, but offers the explosive, leveraged potential to outperform in a bull market and get decimated in a bear market. It is a bet on business and profitability. In the other corner we have the Gold ETF, a simple, liquid, and cheap proxy for gold. It tracks the price with precision but introduces a chain of counterparties between you and the metal, denying you true physical ownership. It is a bet on the price of the metal, held within the very financial system it's meant to insure you against. One is a stick of dynamite, the other is a photograph of a fortress. One offers potential horsepower, the other offers perceived safety. But we've talked enough theory. It's time to put them to the test. What happens when we pit them against each other in the real world with real money on the line? How would a $10,000 investment in each have actually performed during the biggest financial events of the last 2 decades? The dot-com bust, the 2008 meltdown, the COVID crash, and the inflationary surge that followed. Which one came out on top and which one was left in the dust? We're about to run the numbers and declare a definitive winner for different economic scenarios. The final showdown is next. Alright, the stage is set. 2 titans of the gold investment world. 2 historic economic crises. On one side, the nimble, low-cost, exchange-traded fund. On the other, the steady, traditional, actively managed mutual fund. Let's start the clock in February 2020. The world is just beginning to understand the word pandemic. The stock market, after a decade-long bull run, is teetering on the edge of a cliff. And then it falls. In the span of about a month, from mid-February to late March 2020, the S&P 500 plummeted over 30%. It was a waterfall of red. Panic wasn't just in the air, it was the air. In moments like these, investors do what they've done for centuries. They run to gold. But the question is, which vehicle got them to safety faster and with fewer bruises? Let's look at the Gold ETF first. We'll use the giant SPDR Gold Shares, ticker GLD, as our proxy. As the stock market crashed, there was a frantic dash for cash. Investors were selling everything, stocks, bonds, even gold, to cover margin calls and hoard liquidity. Because GLD trades like a stock, it was subject to this real-time panic. In the worst days of the crash, you saw GLD's price whip around violently. More importantly, the bid-ask spread, the tiny gap between the buying and selling price, widened significantly. In normal times, it's a fraction of a penny. During the crash, that gap became a chasm. This meant if you panic sold your ETF, you got a worse price. If you panic bought, you paid a premium. The ETF gave you a front-row seat to the chaos, and for many that was terrifying. It offered an escape hatch, yes, but that hatch was located in the middle of a hurricane. Now let's turn to the Gold Mutual Fund. Let's consider a fund like the Franklin Gold and Precious Metals Fund. Unlike the ETF, this fund doesn't have a price that changes every second. It's priced once at the end of the day, based on its net asset value. During the COVID crash, this was a blessing and a curse. On one hand, it shielded investors from the intraday madness. You put in your sell order in the morning when the market was down 5%, and you didn't have to watch your position get battered second by second. You were insulated from the emotional roller coaster. There was no wide bid-ask spread to worry about. You got the 4 p.m. closing price, period. But here's the curse. What if a flash of good news hit the market at noon and gold prices temporarily spiked? With an ETF, a savvy trader could sell at that peak. With a mutual fund, that opportunity was gone. You were a passenger, not a pilot. You were locked in until the end of the day bell rang. Furthermore, many gold mutual funds aren't 100% physical gold. They often hold gold mining stocks. And what happened to mining stocks during the crash? They got annihilated right alongside the rest of the stock market. So while the gold portion of the fund was acting as a safe haven, the stock portion was an anchor, dragging the fund's overall performance down. So, for the COVID crash scenario, who wins? For the pure, unadulterated safe haven play, the ETF, despite its volatility, was the superior tool. It more closely tracked the real-time price of physical gold. If your goal was to get out or get in at a specific moment, only the ETF gave you that power. The mutual fund, with its mixed assets and end-of-day pricing, proved to be a blunter, less precise instrument in a crisis that demanded surgical precision. The winner of round 1, the gold ETF. But the fight isn't over. A new enemy emerged from the ashes of the pandemic: inflation. By late 2021 and into 2022, prices for everything from gasoline to groceries were soaring. The Federal Reserve, after insisting inflation was transitory, was forced to admit it was a persistent, dangerous problem. This is gold's home turf. This is the scenario gold bugs dream about: a slow, grinding devaluation of currency. How did our two contenders perform in this environment? Let's look at the gold ETF again. As inflation fears mounted, money steadily flowed into funds like GLD. The story here is one of beautiful, boring efficiency. The ETF's primary job is to track the spot price of gold, and it does so with incredible accuracy, minus its very low expense ratio. Over a 2-year period, that low fee, often under 0.25%, is a massive advantage. It's like running a marathon with a lighter pair of shoes. Every step is just a little bit easier, and over 26 miles it makes a world of difference. The ETF did exactly what it was supposed to do. It gave investors a pure, cheap, and direct way to own gold as a hedge against rising prices. No drama, no surprises. Just solid, predictable performance mirroring the underlying commodity. Now let's check in on the gold mutual fund. Remember those mining stocks that hurt it during the crash? Well, in an inflationary environment where the price of gold is rising, those same stocks can become rocket fuel. A mining company has fixed costs to pull an ounce of gold out of the ground. Let's say it costs them $1,200 an ounce. If the price of gold goes from $1,800 to $2,000, their revenue on that ounce goes up by $200. But their costs stay the same. That entire $200 flows straight to their bottom line. Their profits don't just go up, they explode. This is called operating leverage. A good mutual fund manager who can pick the best-run, most profitable mining companies can potentially deliver returns that crush the spot price of gold. However, it's a huge if. The manager could also pick the wrong stocks. A miner could face a labor strike, a mine collapse, or a political shakedown in the country where they operate. All of these are risks that have nothing to do with the price of gold itself. You are betting not just on gold but on the skill of the fund manager. And you are paying dearly for that bet. The mutual fund's expense ratio is often 4 to 5 times higher than the ETF's. That fee is a constant headwind, eating away at your returns year after year. So, in the great inflation battle of 2021 to 2022, who wins? This one is far closer. The mutual fund offered the potential for explosive, outsized returns. But it came with higher fees and a whole new layer of risk, management risk and business risk. The ETF offered a pure, simple and cheap hedge. It wouldn't shoot the lights out, but it also wouldn't fall off a cliff if a mining CEO made a bad decision. For the average investor simply seeking a reliable inflation hedge, the simplicity and low cost of the ETF are almost impossible to beat. The winner of round 2 by a narrow decision, the gold ETF. So is it a clean sweep? Is the ETF simply a better technology that has made the mutual fund obsolete? Not so fast. The real answer, the one that truly matters for your money, is that it depends entirely on who you are as an investor. Let's break it down. A gold ETF is for you if you are a hands-on investor. You have a standard brokerage account and are comfortable placing market orders, limit orders, and stop-loss orders. You want pure, unadulterated exposure to the price of gold. You are cost-conscious and understand that over decades, even a small difference in fees can amount to a fortune. And finally, you value liquidity and the ability to trade in and out of your position at any moment the market is open. A gold mutual fund is for you if you are a set-it-and-forget-it investor. Perhaps you're investing through a 401k or another retirement plan where ETFs aren't even an option. You value the simplicity of automatic investing, contributing a fixed dollar amount every month without having to worry about buying full shares. You believe in active management and want a professional to select not just gold, but a portfolio of precious metals assets that could potentially outperform the metal itself. And you are willing to pay a higher fee for that potential and for the convenience. The final verdict isn't about which one is best. It's about which one is best for you. It's a classic battle between precision and convenience, between low cost and active management, between a pure play and a diversified approach. Ultimately, the choice between a gold ETF and a gold mutual fund is the last decision you should make. The first and most important decision is answering the question, why am I buying gold in the first place? Are you a trader trying to time the market? Are you a long-term investor seeking a 5 to 10% portfolio allocation to hedge against chaos? Are you saving for retirement and just want a simple, automated way to add some shine to your nest egg? Your strategy dictates your tool, not the other way around. Don't get so lost in the weeds comparing expense ratios and trading spreads that you forget to look at the map. The real winner of this showdown is the investor who first defines their destination, and only then chooses the right vehicle to get there. Because a Ferrari is useless in a swamp, and a monster truck is inefficient on a racetrack. Know your terrain. Know your destination. Then and only then can you truly pick a winner.